Yeah, it's a strong performance by the bank, 5.1 billion of operating profit. And it's a combination of obviously the continuing delivery of our strategy and the strong support of our customers. We saw 6.7% increase in lending growth. Really importantly, we stayed in the mortgage market during the period of disruption. We're continuing to lend to business responsibly. So delivery of strategy, good performance, and most importantly, a strong, resilient balance sheet, which means we can continue to support our customers through what still remains challenging macroeconomic conditions.
You've set aside £337 million for doubtful loans. That's lower than the market was expecting. Why is that?
Yeah, we're not seeing any signs of stress on our balance sheet. I think, I would distinguish between the real high anxiety and concern that customers are feeling from the cost of living squeeze. And I think, for businesses, it's really tough out there. When I talk to businesses up and down the country, they're really struggling, but incredibly resilient. But what we're not seeing is that move into arrears in mortgages, for examples, or defaults on loans, or what we call heightened monitoring on our business loans. In fact, our levels remain pre-COVID levels. So that gives you a sense of how resilient the UK economy and households and businesses are being. But it is really tough out there. We're making sure that we're providing and keeping our balance sheet with lots of capital and lots of liquidity so we can deploy it to help people and stand alongside them.
What kind of assumptions are you making about the trajectory of bank rate this year?
Yeah, on our assumptions going forward, we've assumed interest rates stay at 4% for the rest of the year and then gradually reduce over the course of next year. So those are the assumptions that we're making. And then we're working really hard with, businesses and families to think about how we can help them navigate both sides of their balance sheet, whether it's lending and savings to support them.
Obviously, the market's been spooked by your outlook statement on net interest margin this year. I assume that is underpinned by your expectations there on bank rate, which is slightly more dovish than the market as a whole is thinking.
Yeah, our guidance, we're very thoughtful when we give guidance to the market. I mean, we're essentially saying we expect to make a return on tangible equity of between 14 to 16%. I've always talked about making sure the bank is delivering long-term sustainable returns, good capital so that we can support our customers and support the economy. We've made an assumption of 4%. I think the latest forecasts are that may be higher, but I think it's important that we are able to deliver what we say, and we're quite thoughtful about the guidance we give. I think 14 to 16% return on tangible equity will probably be the best guidance that is out there in the market. Importantly, we have liquidity and capital to support the economy.
Obviously, you've come under fire recently for the extent of the interest rate rises from the Bank of England that you're passing on to savers. Why are you not being more generous, as it were?
Well, what we're doing is we're making sure we're really targeting helping people save. 1 in 4 people in this country have less than £100 of savings in their account. So one of the strategies I put in place when I took over was, how do we help build financial resilience? Our digital regular saver account is paying 6% interest, and that's helping people build the habit of saving. You can save as little as £1, but that 6% means it's encouraging people to save. Our Roundup tool, we have over 1 million people using that now on a regular basis, and we've helped 1.7 million people save £100 for the first time. And so that's about building financial resilience. So 6% on our digital regular saver. We have fixed term deposit accounts paying between 3 and 4%. So I think we're paying good interest rates. We have a suite of products, but what I'm really focused on is how can we help build resilience, and particularly in young people as well. Our youth account is paying 2%. And we're doing a lot of work helping young people build financial skills and capability, where post-COVID and in the cost of living, we're seeing real lack of confidence in the younger generation. 80% of them are not confident about their financial capability, and 57% are saying cost of living is the thing that they worry about most. So we are passing on interest rates. We're targeting it around building healthy and sensible savings habits, rewarding it with 6% interest rate.
You mentioned just now that you stayed in the mortgage market during the upheaval of the autumn. What kind of assumptions are you making about the housing market this year?
Yeah, it was really important we stayed in the mortgage market during that period of disruption. It was hugely stressful for customers. We were one of the only banks who stayed in the market. We didn't pull products. What we are seeing with higher interest rates, that there are lower volumes in the mortgage market, as you would understand. And so the Bank of England, I think, put out some data around smaller volumes in the mortgage market. What we're focused on, our customers largely are on fixed rates. Around 92, 93% of our customers have fixed rate. So we're really working with them to say, how do we help you navigate? What are the choices that you have going forward? We are seeing mortgage rates come down closer to 4% now, and I think that's a real positive for households. In terms of house prices, we are seeing a softening in house price. Our economic assumptions are house prices may drop by around 7%. I think the OBR says 10%. Don't forget, house prices rose by 10% over the last year. So there is some softness in that market. The most important thing is helping customers think about what's the right choice for them.
Now, you've increased the size of the bonus pool by £70 million to £367.5 million. Your pay has gone up from £3.6 million to just over £5 million. Is that appropriate during a cost of living crisis?
Well, the bonus awards that we've paid are really reflective of the performance, and NatWest has always been a back marker on bonuses, and I expect us to continue to do so. I think in terms of our reward for our colleagues, we've really focused on those on the lowest salaries as well. For my own pay, clearly in the financial services sector, it's an incredible privilege to do these jobs, and we're very well rewarded, and I'm very cognizant of that. But
you weren't tempted to waive any bonuses in view of the sort of difficulties that a lot of customers are going through right now?
Well, I think it's important that we continue to deliver strong financial performance and reward our colleagues for the job they're doing. As I say, our bonus pool is significantly lower than the rest of the market. We always tend to be a back payer on that, and making sure that we balance that appropriately and retain good talent within the organisation.